All right, we are live. So, all right, guys. So today's lesson, of course, is going to be on risk management and market psychology. I do want to talk about a few things, other than, of course, like the current aspect of the market. So the way this is gonna run out, of course, is we'll start off with the lesson because I want to keep it short. I obviously for those people that can't make it, we don't want to start blabbering on about the market conditions. And then I'll keep the Q&A like for the end of the video. So I am sick right now, so I'm gonna try my best not to cough in the mic or anything for you guys. So starting off, like for the pair that we're gonna be using it for today's example is gonna be Ethereum. Ethereum is one of those things that you guys already know. I trade quite a bit, and it just makes it a lot easier for me to teach. Now, I'm gonna start off with the very basics, as every trader. I'm assuming most of you guys are beginning traders, and they kind of lead into the more expert aspect of it. So, as a beginner, when it comes down to risk management or market psychology or anything like that, you tend to kind of have yourself in a position where you want to make money, right? So, starting off where let's just say you start off $1,000 in the market and you really want to do something with that. The problem is where it comes down to psychology is everyone's risk aspect is a little bit different. So, for example, some people have a little higher of a risk tolerance compared to others that, $20, $30 is a lot of money to them. So, the number one rule, of course, is finding out what kind of trader are you and what kind of risk appetite can you risk losing, right? So, the way I explain it to beginners is when you start off trading, whatever money you put into the chat, Pingu, can you turn? It should be up all the way here. Give me a second here. One second. Sorry, guys. There we go. Okay, that should be better. Okay. Sorry about that. So yeah, so as a beginner, when you first start off trading, what you want to ideally do is put money that you're willing to lose. And I always tell people that in the very beginning because the market doesn't tend to do what you want it to do. It always does opposite. So if for example, if you have $10,000, and you can't lose that $10,000, but you want to learn how to trade, this is where things get extremely risky. You do not want to over leverage yourself or put yourself in a position where you lose that $10,000 and you end up getting evicted or anything like that. Your better bet, of course, is as a beginner, put 10% of your net worth into trading. That's what I explained. Mostly where it comes down to leverage trading. Because this way you're not in a position where you end up losing a lot more than what you're willing to risk, and vice versa, right? You can actually make a little bit of money where you actually care. The problem is when you are a trader, this comes very interesting, right? Is to the point where when you are trading, you tend to start looking for trades or holding trades longer than you should. And what I mean by this is, let's say you have $1,000 account, you make $10, right? You're looking at it like, oh, okay, that's only $10. I'm gonna hold my trade. But what I've always explained to people is, if you can't make money on a $1,000 account, you're not gonna make money on a $100,000 account. You need to get in the mentality that whatever percentage gain is good for you. And of course, I'm not going to give you guys a set number because every trader is different. But whatever percentage gain is good for you, that's the percentage gain that you should stick with. You guys have seen me trade live on Telegram, right? And you guys notice that I usually take those 5, 7, 10% gains every day and they add up very fast. That's the kind of trading mentality that you have to be in, because the problem is with how volatile the current market situations are, you might be in a 10% trade and then it goes completely opposite and you end up losing 30, 40, 50% because you're hoping, oh, once I get 10% again, I'll close the trade. And I'm sure some of you guys can relate to that. The problem is when you are trading, though, you need to get into that mentality of risk management, right? So, explaining risk management basically, I would say, is the best thing you can do for yourself is have that set number of money that you're willing to risk. So, whether it's $1,000, $10,000, and out of that $10,000 or $1,000, your risk per trade should be 3%. The reason a lot of traders, or well, I guess teachers, they'll try to explain, okay, you can use 1 to 2% max. I've been trading for 7 years, and personally for me, 3% risk per trade is a lot better. You guys have seen my trades. My margins are $5,000, $6,000 because again, to me, my risk tolerance is a lot higher. I don't mind losing that money. But when you're a beginner, you don't want to get into the mentality of putting 100% of your trade into the margin, right? For example, let's say you have $1,000 and you're just starting out to trade. You don't want to risk $1,000 per trade. The problem with that is, yeah, sure, you might be able to win 1 or 2 trades, but when you get into a lose streak, and I promise you guys will, because every trader goes through it, when you get into a lose streak, you don't want to end up losing 100% of your margin off 3-4 trades. Ideally, what you want to do is, of course, have that risk percentage. You end up losing 3-4 trades. You might lose, assuming 3% per trade, so 12% total. You're still living another day, right? And that's what you guys have always noticed me say is I live for another day of trading. And that's the hardest point where you have to understand is every trader fails at that. Getting liquidated is extremely shitty, guys. Like, you guys need to understand, like, everyone has that point where they will become liquidated at least once in their trading career. And some people take it as a lesson, other people take it as a gambler mentality. And this is really where market psychology comes into play. So when it comes down to, for example, as a trader for risk management, you can use my golden rule, right? So 3% per trade and money that you don't care about losing. Now, I explained why I take profits at 5, 6, 7%, but I've noticed a lot of beginners, the problem they have is stop losses. And I'm sure a lot of you guys wanted me to, like, I know a lot of you guys wanted me to talk about this, but I'll explain how I rarely get stopped out. I think, honestly, like, I think out of all my trades, even the past 2 weeks, I've been stopped out on 2. And you guys have seen I've posted a ton of trades. This comes down to, obviously, the way you kind of position your charts. And I'll explain now. So what you're looking for when you set up your chart, you guys already know from previous lesson, we went over support and resistance. Now that we have our support and resistance played out, let's say for Ethereum, for this example, we want to look for a shorting position. And let's say, you know what I'll do is I'll zoom this chart out here. So this way you can see that we'll ignore what happened after. We'll just currently look at what the current market conditions are right now. We know that in terms of the resistance level, we're at 1658, okay? And now you want to place your stop losses. A lot of traders, what they'll do is they'll place their stop right above the resistance level. So maybe they'll put it at 1665. And I'll give you an example like this, 1665 or even like 1670. And they'll be like, okay, I'm good. The problem with that is you will get stopped out. You can see in terms of Ethereum's current price, like what happened. We got 1, 2, 3, 4, 5, 6 wicks hitting 1670 before we dropped further. A lot of traders would have gotten stopped out on those positions. What I usually do is when I'm placing a stop loss, mostly at resistance or support, I don't tend to enter that trade until the wick happens. And you guys have seen me trade multiple times, and I'll explain why I do this. But when you're starting out, what you want to do is mostly at resistance or support points, and I'll show you guys support in a second. But what you want to do is you want to place your stop loss once the wick happens. So when you see the 4-hour candlestick close, for example, at 1658, you see this very large green candlestick. A lot of traders would have put their stop loss right here, maybe a 1670. Because they're like, okay, the wick happened. The problem is, this is where my 3 test rule comes from, right? I usually wait for a resistance level to be tested 3 times. Because you will notice that the wick, in terms of the second or third time, that's the wick where you want to place your stop loss a little higher. This is very tricky, right? It's a lot easier said than done. So what I would do is, assuming from previous price, I would look at the current market condition and I'll be like, okay, currently Ethereum, for example, at this range right here, 1612, I'll go back to my chart and I'll look at the previous range. Where exactly did Ethereum wick before it collapsed? You can see right here at 1658, we saw multiple wicks and then a breakout wick. If you pay attention to that breakout wick, it was at 1680. I won't be looking for a position until we get near that area, and then I'll place my stop loss at around 1690. The reason I do that is I'm accounting for the wicks, right? So I'm accounting that the market is going to try to hunt me, and at current market conditions, you can see that if I did do it like that, I wouldn't have been stopped out on this play. I could have entered at 1658 if I was, again, an aggressive trader. Could have entered at that level, waited. My stop loss at 1690, I don't care, right? The market never got close to that. And you can see I would have profited on that trade. Same thing with support. Support was at 1518, for example. looking at previous price analysis, look what happened. We saw a break on support going all the way down to 1479. If I'm entering on 1518 for a long position, my stop loss would have been lower than 1479. I would have maybe placed it at 1470. And this, of course, is really dependent on how you guys, the amount of money you risk, right? Like these are larger, a little bit larger of a stop losses. Not really, but they are, right? So this is why I tell you guys, choose what time frame you guys like. If you guys like 4-hour time frames, your stop loss is going to be a little bit longer, but you're going to be more of a swing trader. If you guys like lower time frames like the hourly, the 30-minute, then your stop losses are going to look a little bit more different, right? So for example, on the hourly, you can see same thing. We tested on the hourly on support going all the way down to around the $1,500 mark. I would have entered a trade on around 1518 for a long, and I would have placed my stop loss maybe a little bit lower around 1495, 1496. I wouldn't have been stopped out. Trade would have played out perfectly. You see what I'm saying in terms of the lower time frames versus the 4-hour time frames? The risk to reward is obviously going to be higher on the higher time frames because they're a lot larger of trade ranges. So your best bet is first figure out, as a trader, which area of trading do you like? And I'm sure you guys are going to question, well, which one do I like? Well, I like the 4 hours. But again, this is me. I'm a completely different trader than what you guys are trying to do, right? Maybe the 4-hour doesn't work for you guys. Maybe at the end of the day, you're better off, you have work, you got kids, you got whatever, and you can't be on the chart every 4 hours. You want to be looking for maybe the hourly or the daily, and all of these things come into play when you're trying to place your stop losses because you have to look at what the charts are telling you. So you can use that example, for example, on the 4-hour, if I'm looking for a long position, I look at the previous chart and I say, okay, we're at $1,502. That's the lowest point of the wick. I'm going to place my stop loss maybe at 1495, 1490. And this obviously depends on your risk, right? Now comes the question of market psychology. This is very tricky to understand. When you're trading and, the trade starts to go against you, this is where emotions come into play. All of a sudden, the market starts to break support. You start to panic. You start to say, okay, I'm against the trade. It's a lot easier for you to look at the trade right now and be like, oh, I wouldn't have closed it. But when you're down 15, 20% and you know that this is going to be a stop hunt, that's where the question really comes. And this is where entry point is everything, right? You guys notice I don't enter trades until we test these magical lines I have drawn. This is the exact reason why. Because if the market goes against me by a little bit, I'm not worried because I know that if the trade were to break support anyways, I was an invalid trade and I'm getting out of that trade. But you can see that Ethereum on this example at 1518, we hit the wick 3 times before we actually continue pushing forward. 3 times. Again, this is where it comes to market psychology where okay, worst case scenario, if it goes anything lower than 1500, I'm getting out of the trade. You can see that it didn't. Trade profited, you're okay. But you need to understand yourself as a trader first. If you guys are one of those traders that, of course, have gambling mentalities, you tend to over leverage your trades, you tend to over trade. That's another big one is over trading. You don't always have to look for a trade every 5 hours, every 4 hours, whatever, because you just want to enter a trade, you want to make money. Let the trades come to you. You guys notice that I don't really look for these trading positions until they hit my entries, right? Once they hit my entry, then I'll base the trade off that. You guys have seen my trades. I've entered trades and within 2 minutes, we're up 20, 30% and we close those trades. The reason why is I'll just let the market come to me. I'm not hunting these trades. I barely look at the charts. And honestly, the only time I do look at the charts is when you guys message me, hey, did you check out this coin? Did you see this? And that's where you guys need to get into the mentality that let the trades come to you. There's absolutely no reason why you should be hunting trades, mostly on weekends. And this is why I tell you guys, always practice your trades. And once again, if you guys are just sitting on the sidelines, click on the link at the bottom. It is Fairdesk. They do give you free money to trade with. And again, simulate your trading and practice these things. I can sit here for the next 30, 45 minutes and try to teach you guys something. But in reality, the problem is, if you're not going to practice these sort of situations and placing your stop losses, you're going to get wrecked every single time. The best thing is for you guys to do is pull up a chart. I don't care if it's Cardano, Ripple, whatever your favorite chart is, and place those stop losses and see whether or not you would have had that trade right. You guys notice I've never changed my charts, and the reason why is these are just major resistance and major support levels. There's absolutely no reason for me to change my charts. Now, if the trade were to go against me, I already know my levels are played out. This comes to market psychology. You know when it's going to be a manipulation. If you have your places set properly, if you have your resistance and support set properly, you will know whether it's a bad trade or it's a manipulated trade. We tend to see a lot of manipulation, mostly in the current market conditions. The reason where everything else ties in together, which you guys remember from last lesson, is of course support, resistance, exponential moving averages, all of this. But stop loss and market psychology isn't something you learn overnight. This is something that you have to practice for a very long time. And once you get it, you'll really get it. You can see the same sort of situation right here. A lot of traders, this was during FTX, a lot of traders entered a shorting position here at 1518, right? Why? Market structure broke. They knew the BART formation was going to play out, but guess what happened? We saw a manipulation wick going all the way up to 1579. This is an extreme manipulation, right? That's a big range from 1518 to 1579, holding that and hoping that it's not going to change. That's a little bit of a different story. And this comes down to risk management. If you're using low leverage, you don't care about this range. Your liquidation would have been $2,000 on maybe 3x. If you're using high leverage, then you would have waited on structure break, wait for the manipulation, because every time we have structure break, whether it's bullish or bearish, we will have a manipulation wick, whether it's trapping all those positions, hoping that the trades are going to go lower, or catching those long opportunities, hoping the trade's going to go higher. Once you see that wick opportunity, you enter the trade, and obviously that was a very profitable trade. But this is why I'm saying I don't trade news events. I hate trading news events because it's very hard to know when market psychology and manipulation comes into play when the trade's against you 60%. You guys saw NFP. I entered a trade on ETH at I think 1531 or something like that, hoping, or was it? Yeah, sorry, 1631, hoping for 1612. Market manipulated, right? We saw the trade come down as Susan sent it. Within 5 minutes, it dropped down to 1625. And immediately after, within 10 minutes, we shot all the way up to 1677. I did get stopped out on that. But again, that's where one of those things come into play is as a beginner, your best bet is just not trade on news events, guys. I don't even trade news events. The only time I'll enter a news event is like at night when the garbage stuff is done and now the choppiness is over, then I'll look for a trade. But my best advice to you guys for market psychology is, guys, don't trade news events. Whether it's bullish or bearish, don't trade them because you will get wrecked. The amount of times when I started, I got liquidated in terms of news events. You guys don't understand. Like, it was almost, I would have the greatest trading month, and then within 3 days trading into a news event, I would be down 60-70%. And looking back, I would be like, okay, well, why do I take such big losses, right? I would just realize it was just trading events. Every time I looked into the charts, it was during Fed meetings, it was during inflation data. It was one of those situations where you just sit out and just watch. I love watching people get liquidated now on AGGR trade, right? It's fun because when you're not sitting on that ship and you're watching people get wrecked, it's a different type of fun. But it's different when you are part of that ship and you didn't trust yourself, you weren't listening to yourself and your rules, you got absolutely wrecked. So the best thing you can do in these situations is trust yourself, trust your market psychology, trust yourself as a trader, and understand that these things are not done overnight. You're going to make mistakes. But if you have your rule sets and you play off the wicks in terms of support and resistance, you will be okay. And again, when it comes down to stop losses, this comes down to every single person in this chat is going to be different. Your risk mentality is going to be different. Your take profit strategy is going to be different. Some people like holding the trade regardless until they hit a massive opportunity. We call those swing traders. There's some people that are scalping guys like me. I like taking those 10% gains within 30 seconds and calling it a day. I like that, right? Because I can go to bed at night knowing the fact that I made a 10% trade and I don't have to sleep every few hours and check the charts. Oh my God, am I going to get wrecked? And I'm sure you guys have been that through, right? This is why I tell you guys, take what's on the table and go from there. Because at the end of the day, when you have a trade and you get hit with that stop loss and then the trade goes where the direction you want it to, you're going to get emotional. You're going to get upset. You're going to be like, wow, I got hunted. The market sucks. You can make up all the excuses you want in the world, but in reality, it was just because you didn't follow your own rule set, right? If you get stopped out on a trade, for example, you enter a trade right here on 1612 and it goes up and you didn't take your profits because you wanted this massive, whatever, the next leg upwards, and you get stop hunted right here. You can see the market dropped all the way down to 1587. You got stopped out. Well, in reality, that's on you. You didn't take your profits when the market gave them to you and you held your trade and you got greedy, right? And I know a lot of you guys have been messaging me in regards to that and saying, I got greedy, I got greedy, I got greedy. And this is one of those things where you guys need to realize that when it comes down to market psychology, everyone in this room is different. And you really need to find out the root problem as to why you got greedy. Do you have a loan on top of your head that you need to pay off? And you thought, oh, if I hold this trade in one shot, I can pay off that loan. Do you have bills every year, whatever? And that's what I'm saying is like, it's one of those situations where you need to realize when you enter a trade, you need to realize that that trade could go to zero. So when you start thinking in that mentality, you won't enter those bad trades. You'll enter only the good trades. And those good trades are, of course, once you have market structure. Once you see the exponential moving averages being used as support, we're breaking above the resistance, RSI is not overbought. Those are the trades that you want to see, right? We're using these levels of support with the EMAs, and I've taught you guys this many times. That's what you're looking for, because then those are very profitable trades. And I'm not going to lie to you guys. You guys saw I tend to close trades earlier and then the move set happens regardless. And this is where I come from a trading background and I say, I don't care. I'm okay with a 20% gain. Yeah, I could have been 100% if I just left it open for another hour, but I don't care because at the end of the day, the market could have gone the opposite way and I could have been down 100%. And that's why I say find a number that you guys enjoy, find a number that you guys are okay with, and take those profits. Don't hold your trades. There's absolutely no reason to be holding those trades. When it really comes down to market psychology, the best thing for you to do is practice, guys. Practice, practice, practice. I can't tell you how many times I stayed up all night just staring at charts. I wasn't even in trades. It really comes down to passion and how much passion you have to become successful in trading. Just stare at the charts and place your stop losses and your resist. You don't even have to enter the trades, guys. You don't even have to do simulation trading if you don't want to. Just draw your lines and look at the charts. And if you see that, oh, that would have been a profitable trade. Oh, that would have been a stop loss. You will get a lot better at placing your stop losses accordingly. This is where, in terms of Ethereum right now, for example, I have resistance at 1658, but look, we have 3 wicks, right? So what I would do, if again, I was looking for a trade, I would just quickly draw another line right here, and I would place my stop loss right above 1678. So maybe like I would draw it right here, for example, and I'll change the color so you guys can see. I'll make that my stop loss, and I'll enter the trade. And that would have been a very profitable trade. But that's pretty much how I enter, right? So like I look at the wicks, see the highest point, see the lowest point, place the stop losses accordingly, and I'll be entering those trades. Otherwise, I won't be looking for a trade, right? If I'm in this consolidation zone, I'm not looking for a trade. There's no reason to be looking for a trade. And that's like the best thing you can do, right? As a trader, why do you need to hunt your trades? Why do you need to make your charts? Guys, trading isn't simple, but it can be as long as your charts are simple. I have seen your charts. You guys have sent me some of your charts. And honestly, I can't even look at your charts properly. I don't understand how you guys will be able to. This is why I explained this comes out to market psychology. You don't need to be looking at your UFO indicator and it's telling you to buy, and the whole price action chart is telling you to short, but your UFO indicator is telling you to buy. So you're like, I'm going to buy. Like, you know what I mean? Like, it's not that difficult. Just don't have any. If you don't want to have indicators, don't have indicators. Just trade off clear price action. But risk management, market psychology, these are things I can't teach within 30 minutes, right? These are things that you really need to focus on yourselves and understand that, hey, as a trader, the more times I lose, the closer I get to becoming successful. And it's a true thing. In my career, in 7 years of trading, I have probably been liquidated over 10, easily over 10 times. And we're not talking small money, folks, a lot. But every time I got liquidated, I got better as a trader and fixed up my rule set. And this is back to point number one. Put money you're willing to lose into the market, not money that you can't live without. If I got liquidated for my life savings, for example, do you understand the kind of emotional trading that I would have done after I came back? It's a gambling mentality. That's why you need to understand, if you lose $100, who cares? You lost $100. If $100 is a lot to you, then switch to $10, right? But at the end of the day, if you can go to bed once you enter a trade and you don't have to look at the chart, that's the kind of risk management you need. You don't need that risking 100% of your account and YOLO trading it. Do you understand what I'm saying? There's absolutely no reason to be risking 100% of your account unless you got, $50, $100, $250,000 in the bank and 10 grand is nothing to you. Then by all means, that's a different level period of trading, right? That's a different trading aspect of it. You can make a ton of money like that. But when you are trading with your life savings, you tend to make more mistakes. You tend to get more upset. You tend to get more emotional. You're not going to win as a trader. You're just going to lose every single time. And that's why I told you guys, market psychology is one of those things that you really need to practice. And I'm not saying I'm perfect. You guys have seen I've lost trades too. Because at the end of the day, you just need to realize it was a bad trade. It just wasn't the right setup, and learn from it. As long as you learn from it and you don't make the same mistake twice, you will become a profitable trader. It took me 2.5 years to become a profitable trader. It took me 5 years to become a profitable trader trading for hedge funds. And then I took a year off. I just couldn't do it anymore. Market mentality wise, I was exhausted. Imagine. For someone like me who only has been staring at charts all day, and I have whale friends, and just they'll send me a stock or something to analyze. I can see in the chat too, you guys are asking for analyze this, analyze that. But this is where it comes down to, right? Me as a trader, I just needed to learn psychology wise. I'm over trading. I'm staring too much at the charts. Go outside, put your phone away, spend some time with friends. The charts are always going to be here. The trades will always have setups. And once you really find out that balance in life, you will become a successful trader. I trade maybe 3 or 4 times a week, and that's still a lot, even for me. But out of those 3 and 4 trades, I'd say 3 of them are profitable, and you guys have seen that in Telegram. They're very profitable trades. You guys have made a ton of money off me, and I'm very happy, because if I'm helping someone learn as they're making money, that's my rule. I don't have courses. I don't sell signals. I don't have anything. It's all free, right? Because at the end of the day, that's all it is. You don't need to pay for education. You just need to practice. You know yourself better than anyone. All these mentors and gurus, you're going to pay $1,000 and they're not going to teach you anything because they don't know how you are as a trader. They can have a market plan. They can have a market structure. But at the end of the day, if you don't even follow your own rule set, what's the guy going to do for you, right? It's pointless. It's a waste of money. So the best thing you can do is focus on yourself. And for those of you that are asking me for charts, this is an educational content. What I'm going to do is I'm going to end the video here, because for those of you people that obviously couldn't watch, and I'll start the live session again, and then we can start looking at charts, whatever you guys want. But I'm going to end the session right here just because we're hitting that 30-minute mark. It's an educational content only. And then we'll go ahead and start a new one, and then we can have more of a casual, ask your questions, ask your chart analysis, whatever you guys want. So give me 5 minutes, guys. I'm going to end the session here, but thank you guys for coming, and I hope you guys learned something from this market psychology or even risk management. And I really appreciate you guys. I'm sorry I'm dying. My voice is so bad, but I'm struggling to talk. But yeah, give me